Something impossible just happened in the gold market. Something that defies the fundamental laws of finance. Something that has occurred only a handful of times in modern history. And every single time it has happened, a catastrophic financial event followed. Gold futures are trading below the spot price. Read that again. The price of gold for future delivery is cheaper than the price of gold right now. This is called backwardation. And in the gold market, it should not exist. It is the financial equivalent of water flowing uphill. It breaks the rules. It defies gravity. And when financial gravity breaks, something massive is about to snap. In a normal market, futures always trade above spot. Always. The premium is called contango. It covers storage costs, insurance, and the time value of money. Futures above spot is the default state of every functioning commodity market. It has been the norm for decades, centuries even. When futures drop below spot, it means something is fundamentally broken. It means the market is screaming that physical gold today is worth more than promises of gold tomorrow. It means trust in the delivery system is collapsing. It means sophisticated traders believe there will not be enough gold to deliver in the future. It means the paper market is about to die. Let me show you exactly what is happening, why it matters, and what history tells us comes next. To understand why gold backwardation is such an extreme signal, you need to understand the difference between contango and backwardation. Because these are not just technical terms, they reveal the fundamental health of the market. In a normal gold market, the futures price is higher than the spot price. This is called contango. Here is why it exists. Imagine you want to buy gold for delivery in 6 months. The seller has to store that gold for 6 months. They have to insure it. They have to pay warehouse fees. They have to tie up capital that could be earning interest elsewhere. All of these costs get added to the price, so the future price is naturally higher than today's price. If gold spot is $2,700, the 6-month future might be $2,740. That $40 premium covers the cost of carry. It is logical, it is mathematical, it is how every commodity market is supposed to work. Backwardation is the opposite. The future price is lower than the spot price. Gold spot is $2,700, but the 6-month future is $2,660. That means the market values gold in your hand right now more than gold promised for delivery in the future. In most commodity markets, backwardation happens regularly. Oil goes into backwardation when current supply is tight. Wheat goes into backwardation during drought. These commodities are consumed. Current shortage can create urgent demand. But gold is different. Gold is not consumed. It is hoarded. Every ounce of gold ever mined still exists somewhere. There is no shortage of above-ground gold. There are approximately 210,000 metric tons of it sitting in vaults, central banks, jewelry boxes, and private hoards around the world. In theory, if futures drop below spot, arbitrageurs would immediately act. They would sell physical gold at the higher spot price, buy the cheaper future, and pocket the difference. This arbitrage should instantly eliminate the backwardation. It should be impossible for backwardation to persist in gold, unless something is very wrong. Unless the arbitrageurs cannot access physical gold. Unless the gold that supposedly exists in vaults is not actually there. Unless the delivery system is broken. Unless holding physical gold today is so critical that no one will sell at any price. Gold backwardation is not a technical glitch. It is a warning siren. It is the market telling you that the paper system is failing. And this week, that siren started screaming. Let me walk you through exactly what the data is showing, because the numbers tell a story that is impossible to ignore. On Monday, the August gold futures contract settled at $2,783. The spot price at the close was $2,797. That is a $14 backwardation. Futures trading below spot by $14. On Tuesday, the gap widened. August futures closed at $2,679. Spot closed at $2,700. Backwardation of $20. By Wednesday, the spread hit $31, spot at $2,708. August futures at $2,677. By Thursday, the backwardation was $38. the widest gap in any major gold contract since 1999. Every day this week, the spread has grown. Every day, the market has spoken louder. Physical gold is worth more than paper promises, and the gap is accelerating. But here is what makes this truly alarming. It is not just the front-month contract showing backwardation. The entire futures curve has inverted. The December contract is below August. The February contract is below December. The further out you look, the cheaper gold becomes. In a functioning market, this is impossible. The cost of carry means longer-dated futures should always be more expensive than shorter-dated futures. Always. When the entire curve inverts, it means the market has completely broken down. It means nobody trusts any future delivery date. It means the market is saying that gold in hand today is the only gold that matters. Now, let me show you what happened in the physical market simultaneously, because the paper market and the physical market are telling opposite stories. While futures were dropping below spot, physical premiums exploded. The premium for a 1-ounce American Gold Eagle over spot jumped from $65 to $120 this week. The premium for a 1-kilo bar jumped from $25 to $55. Dealers are reporting multi-week delivery delays. Several major online dealers have listed common products as out of stock or pre-order only. Premiums in Dubai hit $80 over the London paper price. Premiums in Shanghai exceeded $50. Premiums in Mumbai reached $65. The entire physical market is screaming shortage while the paper market pretends there is plenty. The COMEX delivery data confirms the stress. Standing delivery notices have spiked. Registered inventory has dropped by 8% in the past month alone. Metal is leaving the vaults at an accelerating rate. The paper market is saying gold is cheaper tomorrow. The physical market is saying you cannot get gold at all. This is not a contradiction. This is a signal. The paper market is dying. The physical market is absorbing what is left, and backwardation is the symptom of that death. But why now? What triggered this specific breakdown at this specific moment? There are 3 factors that converged this week. Factor 1, a major delivery failure rumor. Multiple sources within the London gold market reported that a significant bullion bank was unable to meet a delivery obligation this week. The rumor has not been officially confirmed, but the market behavior is consistent with a delivery failure. When participants fear their counterparty cannot deliver, they demand spot gold instead of futures. They pay the premium for certainty. Factor 2, central bank buying acceleration. The People's Bank of China reported another significant gold purchase this month, their 31st consecutive month of buying. But private intelligence suggests the actual purchase was 3 to 4 times the official number. Other central banks, including India, Poland, and Turkey, also increased buying. When central banks take delivery, that gold leaves the market permanently. Factor 3, geopolitical escalation. Tensions in the Taiwan Strait and the Middle East have intensified this week. When geopolitical risk rises, sophisticated investors move from paper gold to physical gold. They do not trust that futures will be delivered during a crisis. They want metal in their vaults. This flight to physical drains the supply that backs paper claims. Gold backwardation is so rare that it deserves a historical analysis. Because every time it has occurred, the consequences were severe. The pattern is consistent. Backwardation signals a failure in the paper system, and failure leads to dramatic repricing. The Washington Agreement crisis. In September 1999, gold briefly went into backwardation when European central banks announced they would limit gold sales and lending. The market realized that the gold lease market, which had been suppressing prices for years, was being shut down. The backwardation lasted only a few days, but gold rallied from $250 to $330 within weeks, a 32% increase. The backwardation signaled the bottom of a 20-year bear market. Anyone who bought during backwardation saw massive returns over the following decade as gold rose from $250 to $1,800. The financial crisis. Gold went into backwardation twice during the 2008 meltdown. The first episode was in November 2008 when Lehman Brothers had collapsed. and the entire financial system was seizing up. Physical gold became virtually impossible to find. Dealers sold out. Premiums hit record levels. Futures dropped below spot because nobody trusted the delivery system. Gold was $720 during the backwardation. Within 3 years, it reached $1,900, a 164% gain from the backwardation signal. Those who understood what backwardation meant and bought physical were rewarded generationally. The second episode occurred in early 2009 during the peak of the banking crisis. Same pattern: physical unavailable, paper worthless, backwardation screaming that the system was broken, the paper gold crash. In April 2013, gold experienced a massive paper sell-off. Prices crashed from $1,600 to $1,300 in 2 days. It was the largest 2-day decline in 30 years. But during the crash, backwardation appeared briefly. Why? Because while paper gold was being dumped, physical buyers in Asia bought every ounce available. Premiums in Shanghai hit $40 over London. Indian imports set monthly records. The paper market said gold was worth $300. The physical market said, try to find some at any price. The backwardation resolved as physical markets repriced higher. Gold eventually recovered to $2,000 and beyond. The COVID dislocation. In March 2020, gold went into severe backwardation as the pandemic shut down the logistics networks that move physical gold. Flights were canceled, refineries closed, the COMEX delivery system nearly broke. The spread between COMEX futures and London spot exceeded $100 at one point. It was the most extreme dislocation in modern gold market history. And it happened because physical gold could not be moved to where it was needed. The paper market continued trading as if everything was normal, but the physical market had seized up. Gold was $2,500 during the COVID backwardation. It reached $2,075 within 5 months, a 38% gain from the backwardation signal. The pattern across all 4 episodes is identical. Backwardation signals physical shortage and paper market stress. Physical premiums explode. The paper price initially appears weak because futures are dropping, but the physical price is strong and rising. Eventually, the paper price catches up to physical reality. Gold reprices dramatically higher. The current backwardation fits this pattern exactly. And if history is any guide, the repricing that follows will be significant. Let me explain why gold backwardation affects you personally. Because this is not just a signal for gold traders. It is a warning about the entire financial system. First, backwardation confirms the paper-physical disconnect we have been discussing on this channel. The ghost market, the 250-to-1 paper leverage, the phantom claims on metal that does not exist. Backwardation is what happens when that system starts to fail. When enough participants demand physical instead of paper, the structure buckles. If the gold delivery system fails, the silver delivery system is next. If precious metals markets decouple, confidence in all paper markets erodes. If investors realize that paper claims are not equivalent to physical assets, the repricing extends to every asset class. Second, backwardation signals coming inflation. Every major backwardation episode in gold preceded a period of monetary expansion. 1999 preceded the dot-com bust and the first round of easy money. 2008 preceded the largest money printing in history up to that point. 2020 preceded the largest money printing in history period. Backwardation tells you that the physical market knows something the paper market has not priced in yet. It knows that the central banks will print, it knows that inflation is coming, it knows that the purchasing power of paper currencies is about to decline. That is why physical gold commands a premium. It is pricing in the future debasement. Third, backwardation exposes counterparty risk. When futures trade below spot, the market is saying that delivery promises are not trustworthy. If delivery promises in the gold market are not trustworthy, what about delivery promises in the bond market, in the banking system, in your retirement account? Counterparty risk is the risk that the person who owes you something cannot pay. Backwardation reveals that this risk is rising across the system. Your bank deposit is a promise. Your bond fund is a promise. Your ETF shares are a promise. Backwardation is telling you that promises are becoming less reliable. Fourth, backwardation creates a buying opportunity. During every backwardation episode, paper gold appeared cheap while physical gold was expensive. Investors who focused on the paper price thought gold was weak. Investors who understood the signal knew gold was about to explode higher. The current backwardation is offering the same opportunity. Paper prices look soft. Physical premiums look expensive. The uninformed see weakness. The informed see the signal of a lifetime. Fifth, backwardation accelerates the move to physical. When sophisticated investors see backwardation, they convert paper claims to physical metal. They demand delivery. They drain the vaults. This increases the physical shortage, which widens the backwardation, which triggers more conversions. A feedback loop that drains the system faster and faster. The backwardation is not just a symptom, it is a catalyst. It accelerates the very breakdown it is signaling. So, what do you do when the gold market flashes a backwardation signal? How do you position yourself for what history says is coming next? Step 1. Understand what backwardation is telling you. It is telling you that physical is king, that paper is failing, that the delivery system is under stress, that a major repricing is approaching. This is not a time for complacency. This is a time for action. Step 2. Buy physical gold and silver immediately. Backwardation is the clearest possible signal that physical metal is becoming scarce. The window to acquire metal at current prices is closing. When the repricing comes, premiums will be astronomical and inventory will be non-existent. If you have $500, buy 15 ounces of silver. I know this is a gold video, but silver is more accessible at lower budgets and will benefit from the same dynamics. Physical rounds from a reputable dealer. Shipped to your home. Store securely. If you have $2,500, buy 1/4 ounce of gold and 50 ounces of silver. Get exposure to both metals. The backwardation signal applies to the entire precious metals complex, not just gold. If you have $10,000, buy 1 full ounce of gold and 150 to 200 ounces of silver. Consider splitting storage between home safe and private vault. At this level, you are building serious protection against the coming repricing. If you have $50,000, allocate $12,000 to $15,000 to physical metals, 3 to 4 ounces of gold, and 300 to 500 ounces of silver. Consider allocated storage in a private vault outside the banking system. Consider international storage for a portion. If you have $100,000 or more, target 25% to 30% in physical precious metals. This is what the backwardation signal warrants. History shows 30% to 160% gains from backwardation signal to peak. Position size accordingly. Step 3. Avoid paper gold entirely. This is critical during backwardation. The entire signal is about paper failing. If you own GLD, sell it. If you own futures, close them or stand for delivery. If you have an unallocated gold account, demand physical delivery or close it. During backwardation, paper claims are actively losing value relative to physical. Every day you hold paper instead of physical, you fall further behind. The wealth transfer is from paper holders to physical holders. Choose your side. Step 4. If you already own physical, do not sell. Under any circumstances, backwardation means your physical metal is more valuable than the market price suggests. The paper price is lying. The physical reality is that your metal is worth more than any screen shows. Dealers may quote you a price based on the suppressed paper market, but the actual replacement cost, what it would cost you to buy the same metal back, is much higher. Selling physical during backwardation is like selling your house during a hurricane because the assessor lowered the appraisal. Ignore the paper price, hold the physical. Step 5. Monitor the backwardation spread daily. The spread between spot and futures is a real-time indicator of system stress. If the backwardation widens, the crisis is intensifying. If it narrows and returns to contango, the immediate stress has passed, but the underlying problems remain. I will be tracking the spread daily and providing updates on this channel. Subscribe and turn on notifications. Backwardation episodes can resolve quickly or persist for weeks. Each day's data tells you how close we are to the breaking point. Step 6. Prepare for the aftermath. When backwardation resolves, it typically resolves upward. The paper price catches up to physical reality. Gold reprices higher, sometimes much higher. Be prepared for volatility in both directions, but maintain your physical position regardless. The aftermath of backwardation often includes Federal Reserve intervention, money printing, rate cuts, emergency measures. All of these are inflationary. All of these support higher gold and silver prices. The backwardation is the preview. The policy response is the main event. Gold backwardation, futures below spot, the financial equivalent of water flowing uphill. It should not exist, but it does. And every single time it has appeared in history, a major repricing followed. 32% in 1999, 164% in 2008, 38% in 2020. The signal is flashing now. The question is whether you will act on it or ignore it. But backwardation in gold is only half the story. Silver is showing even more extreme signals. There is a specific indicator in the silver market that has never reached its current level. Not in 1980, not in 2008, not in 2020, never. And it just broke through its all-time extreme this morning. I reveal exactly what that indicator is and what it means for silver prices in this video right here. Click it now. The backwardation signal is live, the clock is ticking. I will see you there.